Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. So, to impose tariffs or not, that has certainly been the question. It's been a whirlwind 24 hours for Canada and the U.S. as it was announced late yesterday afternoon that Trump's impending tariffs would be paused until March the 1st of this year. With Trump in office in the U.S. for just shy of 1 month, market volatility is most certainly surging. And our next guest has the perfect word for the new administration. She calls it mercurial. How might investors turn moments of uncertainty into opportunity? Joining us now to unpack where she's finding high-quality investment opportunities in today's market environment and to provide an update on the Fidelity U.S. Dividend Fund is multi-award-winning portfolio manager Ramona Persaud. Great to see you. Hi, Ramona.
Hi, Pamela. Nice to see you too.
Delighted to have this chance to speak with you. So let's dig into what actually you make of this from your market perspective, from the way you invest, the new administration, and ultimately the policies that are influencing the markets that we are watching right now across the board, particularly in Canada.
So let's step back really quickly. I will give a brief overview of what we're trying to do, which is have excess return, but with downside protection and a certain amount of dividends. And the downside protection piece is really important because it reduces churn into portfolios, which helps end investors capture more of the fund's ultimate return. So the reason I mentioned that is when you're opening about market volatility going higher from week to week, depending on the issue of the week, it really helps to have a more conservative strategy when volatility spikes. So it's been a good time to test the mandate, if you will. In terms of what you mentioned to start off with tariffs, to open this week, definitely difficult if you are on the receiving end of that kind of negotiating strategy, and difficult on this side of things too, because the unexpected nature of the policy from week to week, day to day, for months now is, I think, difficult just for humans to absorb, and also, of course, for markets to absorb. So last week, this wasn't policy related, but this was market concentration related. So it was about AI. This week is about tariffs. Maybe it will change midweek. Maybe it will change this afternoon. Maybe it will change next week. The way that I think about this, and what I've thought since the outcome of the election, is that we will have more exogenous volatility. So meaning volatility that is even less predictable than average. And during periods where there is more exogenous volatility, I like to lean into companies that are at the margin more in control of their destiny. So whether that is from high quality with good pricing power, or from turning around their business, or from a portfolio transformation, or from a product cycle that's not necessarily AI related, or just another category of companies is just where valuations are washed out.
Right.
Those kind of companies have more protection around their longer term returns in periods of higher exogenous volatility. So that's been my approach definitely for the last few months since the election happened.
So since the election, and I wonder if you can even go, a little bit back into recent history, sort of historically, how you've been able to use the strategy you just described, exogenous volatility. It's coming from sort of outside factors, a lot of them geopolitical, not always, but a lot of them. Like even just going back sort of 6 months before the election, there were an awful lot of events that the market plowed through, but had to kind of get used to in real time. And there were some fairly violent swings then too.
That's right. You make a good point. Last year was interesting. Every year now is so interesting. So we opened the year with incredible market concentration in glamour, as I call it, glamour tech. And then economic data improved. And so sentiment around monetary policy, not just in the US, but across the world, really improved. So we got this, what is called broadening out. So the market became less concentrated. And then fear set in again. and the market reconcentrated into AI all in 1 year. And valuation dispersions or spreads or differences accordingly sort of followed that, or you could argue led that. So I actually think that we might be set up for a similar sort of dynamic this year where the market is oscillating almost like a harmonica, if you will, or not a harmonica, an accordion is what I mean to say, an accordion.
Yep.
Between concentration in the glamour stuff, because the pace of innovation there has really captured the imagination of a large swath of market participants, and that innovation is so fast that I think it can continue to capture the market. And then you get, like we saw last week, these moments of fear from indigestion or the risk of indigestion, which then broadens the market out again. So I've been wondering if after watching last week, if that's the kind of market we might be in again this year. And what happened last year was where I ended up getting most of my return was from these periodic moments of volatility. So like late May was the French election. So the French market sold off because that was an exogenous sort of moment that just created really good valuations there. And then shortly after, it was sort of mid-July where inflation data changed enough to change monetary policy expectations. You got this massive broadening out and what got interesting in the market again. And then early August was the violent yen carry trade unwind that just opened up Japan. So you got all this opportunity in relatively high quality Japanese stocks. And then from there, we got into election volatility. So I actually think we might have a version of that this year that might be even more exogenous. If the early part of this year is any indication, that can really lead to some dispersion and therefore greater reward to stock picking.
You've mentioned a little bit how you approach things, your style. Let's go into that a bit more, maybe just starting with the fact that, first of all, you're an international investor. You go around the world. You can take a look at France after an election situation because you go hunting there. Tell us a little bit about where you're going hunting.
So yes, it's nice to be a global investor. When we were constructing this fund, putting this fund together probably 15 years now, it was really important to me to be global because you can get a measure of anti-correlation if you are able to invest across the entire world. So you're not just tied into one market driven by one thing, such as, say, the U.S. in the last few years driven by glamour tech. So last year, as I mentioned, France got interesting for a moment, but in that moment, you can add a whole lot of, stock at cheap valuations. And then Japan got really interesting for like one night. That was a couple of weeks after, but that one night was a lot of stocks got really cheap. And the last couple of years, it's just a question of hunting dispersion. So smaller companies, when you got this really high level of concentration, smaller companies got cheaper than larger companies relative to that historical difference over time. Right now, an example of really interesting dispersion that opened up even more yesterday is what I call US versus ex-US. So everything outside of the US. And if you look at that valuation difference measured over a long period of time, today it is greater than 2 standard deviations versus its historical level, which is really big. So when stuff starts to go beyond 1 standard deviation and starts to approach 2, it gets really interesting. So that's been very good alpha signal to me to sort of reinforce what we see bottom up if you look stock by stock. So there are all kinds of examples. If you look at sort of multi-industrials that are based in Europe versus similar businesses in the US, big valuation differences. Consumer stocks in Europe, bank stocks in Europe versus similar in the US, big valuation differences, even healthcare stocks, even though they're all very cheap. So I've just been leaning into those valuation differences, understanding that with the kind of exogenous volatility that we're seeing, we might get an even wider spread, but often when you go beyond 2 standard deviations, you tend to get pretty good reversion in a decent amount.
So do you mind just giving us a picture, a visual of what you're doing when you're watching things get approaching 2 standard deviations? Are you rushing to your computer? Are you having a chat with your team? What actually are you doing? I'm kind of fascinated.
Well, honestly, what the day by day looks like is you are digesting a lot of research and to some extent meeting a lot of companies. There are times, this is a somewhat unorthodox view, but there's some people who share this view. There are times that it makes sense to talk to companies, and there are times like when you're in the middle of dislocation that it can actually not make sense to talk to companies. So, for instance, last week on the Monday, when there was this panic over AI and pricing power in leading edge innovation, one of the suppliers, if you will, to the technology was actually in house, which would have been a great meeting. But I'm sure the entire meeting was going to be focused on, is this real? And how much does this affect your business? And on the day of, the person who's come in can't actually say. So what everybody is looking for is reassurance, and what that CEO is very likely to provide is reassurance. And that's probably not what you need. So most of my day ordinarily is spent figuring out which research and which access to companies is going to push my thinking as opposed to confirm my biases or confirm or comfort me, if you will. So I spend a lot of time trying to be very discerning about how I spend my time, if you will, and then a ton of time reading research from all over the world to figure out what it looks like from the bottom up. And what you're seeing today is there is a decent amount of valuation dislocation in Japan, definitely continental Europe, definitely the UK. For instance, UK banks relative to Southern European banks have lagged. They're still cheap. They've got this margin catch up in the absence of a big credit cycle, which is a big if. And there's this is more true Northern Europe versus Southern Europe, and there's potential for big capital return. So that's interesting to me to pay 1 times book or less relative to US banks that are priced much more richly than that, as an example. So I'm constantly just doing comparisons and essentially optimizations all around the world to figure out where the valuation differences are big enough so that you could lean into those differences and essentially get protected on your longer term return because the difference is widening.
In order to get to sort of your just thoughts on the consumer and actually kind of the consumer staples or consumer discretionary, as it may be, the health of the consumer in the U.S., it appears to be good. Sometimes sentiment doesn't tell you that exactly, but it appears to be pretty strong. There's a consumer discretionary story there. What do you notice around the world? Are there catch-ups in different phases? I mean, their rate situations, their inflation and rates situations are quite different in a lot of cases. What does that mean for the consumer as vis-a-vis you look at consumer stocks?
It's hard to call sentiment because sentiment is driven by exogenous variables that can be hard to predict, like government administration policy. So if you've got, for instance, lots of threat of trade war, what will that do to the end consumer? Say the consumer sitting in Canada this week, or Mexico, or I don't know, South Africa. So really, to me, what is more meaningful is where do valuations get to. So if I can look at one stock versus another, even if they're in the same market and they're in similar businesses, and what I'm essentially doing is looking at their valuation, the difference in valuation between the two stocks, and comparing that difference to the historical difference, and then making a judgment based on having met the company and listened to companies across the whole ecosystem about whether anything greater than the historical difference makes sense. And if it doesn't, then that creates opportunity to lean into the much cheaper one. And of course, what you're trying to then assess is whether there's enough structural change between any given two companies to justify a big valuation difference versus history. And so currently, say Europe versus the US, there's this term that has come into the parlance again with force, which is US exceptionalism. And that sentiment, I think, is contributing to even more of a valuation disparity between US and ex-US. And that is, to me, that is what active stock picking is all about.
Okay.
So continuing to just look for valuation differences across the world, I think, is is the work that we're all doing here.
Has U.S. exceptionalism hit the Uber driver conversation yet, or are we that far? Or what's the demonstration?
That is a real cocktail party. It's definitely in the cocktail party scene.
Yeah, it is.
So that's when like when you really start. I mean, you could probably Google Trends it, right? And I'm guessing it's got some nice momentum to it in Google Trends. I'm guessing you could then like go and try to study that versus, add that to valuation difference to like future return and get some sort of relationship.
So it's getting there, or it's there. It's of interest to you. You have sort of implied some of the examples and how you invest, but mostly you're looking at large cap companies around the world with a value side.
Yeah, the strategy lends itself to large. If I always start out my talks by explaining why that I want alpha like everyone else, but I also want downside protection and some yield, and I do that to reinforce the point that we're trying to set end investors up to get as close to capturing the full return of the underlying fund. That really puts a highlight on downside protection, right? We know this through time. There's so many funds that do really well, and the end investor doesn't do as well as the fund because they're churning. And they're churning because of the fear and greed that the volatility of the market and the fund creates. So the issue with a downside protection focus is it creates this massive bias to stability and predictability, which tends to be heavily concentrated, of course, in the largest parts of the market. Yeah. So when I really explicitly try to lean away from that is, again, when the valuation difference between, let's say, SMID, so small and mid cap, and large to mega, when that valuation difference is really big, and it got really big sort of before, July 9th last year when the inflation data changed, it really got to like a big difference. And so I was trying to lean into it. But there's only so much I can if I'm really prioritizing downside protection.
You prioritize taking a look at, it's a return strategy, a total return. You're looking at things. Dividends are a big part of it. It's the name of the fund that we're going to be discussing a little bit. Does your investing lean more towards international markets than U.S., specifically for dividends? So maybe you can pick that apart a bit.
It's not a fixed answer. It depends on where the opportunity is. So if we believe that the data says that there's a big valuation difference between U.S. and ex-U.S. So that would imply there is a big dividend yield difference between the two, unless there's some big difference in payouts post-COVID. So there is a big dividend yield difference between the two. So accordingly, I wouldn't necessarily go chasing yield outside of the U.S. What I'm actually chasing is valuation differences, which will then have the outcome of leaning into yield outside of the U.S. And I'm also trying to do it with this extra layer of companies that are in the middle of like internal change that is not as driven by the external environment. So there is a healthcare conglomerate in Germany that is transforming themselves and very cheap with good yield potential. There is big energy company that's also going through a transformation that's also very cheap. There's like a railroad in the U.S. that's in the middle of a turnaround. There's a company that just was unable to do a big deal that might be able to do the deal again or another deal under this different administration. So there are all sorts of situations across the world where there's something, you could call it special situation-y, that the company has more control of than, say, the external environment, at decent valuations with decent yields. That's more appealing to me when exogenous volatility is higher than average.
Okay, here's a question on standard deviation. Do you expect the change in standard deviation and volatility to be offset by expected stronger earnings growth in the U.S.? That leads into the earnings picture you have, but.
Do I expect the valuation difference to be offset by stronger
volatility?
I understand the question.
Okay. Do you? Yeah.
Yes, I get the question. It sort of is the big valuation difference essentially trying to highlight a big difference in earnings expectations. I think it is trying to point to that again to the theme of U.S. exceptionalism, and you really then have to make a call on the impact of the technology sector which has driven that big earnings difference, earnings growth difference. Glamour tech has driven overall market growth and free cash flow margins, which has driven this valuation difference. So then you have to ask yourself, like what we saw last week in AI, how much does that matter? And it's a really big question. I don't have the answer to it, but I know that when when the difference gets that distended, there is pretty strong signal in it. So I almost don't need to know. I almost don't need to make the call on tech, especially at still glamour tech. It's still pretty rich valuations because the valuation difference between US and ex-US almost tells you everything you need to know. I'll give you another example that might be a bit more concrete, which is that the US proportion in the global market index, the global market index is called MSCI All Country. It's like the whole world. The US is 66% of that index. And this is a sort of market cap weighted index that's rebalanced quarterly. And it's not rebalanced for performance, if you will. So it's got this massive momentum quality to it because it's rebalanced into market cap.
Wow.
66%. So 2/3 of that index is the US based on how the US has done. And 25% of that index is glamour tech. So that is actually very telling. What that is saying is that the market is very much expecting this to continue. And when I get such a big valuation difference, it sort of is really setting you up to take the other side of that trade.
Right. That's fascinating, actually. That's fascinating. I mean, how much it's worth in terms of market cap, but also, as you say, you'd have to be betting against it, essentially.
Yeah, and if you can find what I call companies undisturbed or relatively undisturbed by AI. So what we also saw last week was the extent to which AI is pervasive inside of the economy. So you saw it in utilities. You saw utilities down like 20%, which is not normal. And you saw industrial companies, even HVAC companies, that were down quite significantly because of the extent to which AI is embedded in expectations.
That's for the cooling element of AI, this sort of picks and shovel
that's right,
cooling
the cooling
piece?
of data centers.
Okay.
That's exactly right. So to me, if you can find companies or even find pair trades that relatively speaking, don't benefit as much from having to make a call on this theme. So as a small example, Target versus Walmart relative valuation, pretty distended. Boeing versus GE, Costco versus, say, BJ's, Costco versus almost anything else. Large cap pharma versus almost anything else. So to me, it really plays into the process of looking for where the relative comparison of everything that we think about is just off versus history, because that tends to be pretty good alpha signal.
That's really interesting. What do you think last week, DeepSeek and so on, clarified for you, if anything? I mean, it was a week, I think, when a lot of people dove in to sort of take a look at what it was going to mean for them in some way. What came out of that for you?
So many things. One, really positively, is it highlighted and reinforced the technical expertise that we have in-house and the access that we have. So many people who are really strong growth investors and understand the ins and outs of the technology very well came together in all sorts of various forms on that Monday, and even met with one of the big AI companies here in the US that same day, like on the fly, and brought all of that knowledge to the entire organization. So the knowledge base of the entire organization, it's the phrase is necessity is the mother of invention. For the people like me that didn't really need to know all of the technicalities, like we got a really intensive deep dive in one day. So I ended up feeling this massive appreciation for the strength of our research franchise and the sharing and collaboration that we do. I also, at a very high level, ended up thinking about price versus volume in any industry. And if you've got an industry that is super leading edge and incredibly fast paced, the way that this one is, there will be stretches or moments of fear about pricing power versus volume. There's often in innovation a transition from when something is really great and interesting but extremely expensive to when it experiences disinflation or deflation such that you can make a whole lot more of it, and then it can be more widely available. And that wide availability tends to be an extreme positive for the economy and the world, but you will have many moments of boom bust cycles or indigestion. So I ended up, thinking about that again, thinking about the internet and the vision for the internet going into the big market cycle in the late 90s. And what I also thought about was suppliers of incredible innovation versus consumers. So are all types of supply now at risk, or are there certain types of supply? So suppliers that benefit from pricing versus suppliers that benefit from volume. So that's an interesting distinction. And thinking about what is in my fund that may be exposed to this, because we saw the pervasive nature of AI all across the economy. And the stuff in my fund, is it more exposed to pricing power or is it more exposed to volume? Of course, I would want the latter as we start to have moments of fear about price versus volume. So those were some of my reflections that, frankly, don't need me to have incredible technical expertise. So I can spend my time thinking on different things, thinking much more big picture and thinking about just valuation differences across the entire world and where we can find opportunity.
That's fantastic. Give us a moment as we close out on dividends right now. It's an interesting story versus rates. It's an interesting time to sort of look at the bond proxies, which sometimes are great dividend producers. Just a little nod to those and how you're looking at them these days.
So yes, if we are I'll try to be simple. If we are going to oscillate, if you think about the accordion,
yes,
oscillate between sort of enthusiasm about innovation and AI, because that's legit. It is really impressive, the innovation. And if the market's going to oscillate between that and companies that aren't involved in that, every time we have fear about that innovation, the companies that aren't involved in this incredible innovation tend to be boring, old economy, super high quality, own their market companies, which means they gush cash, which means they pay great dividends. So if I am watching this oscillation, as I did last year, and waiting for moments of volatility to open up valuations, then you'll probably see me leaning in and out of companies depending on valuation, which is what I usually do, but it was extreme last year and expect it to be extreme again this year. So a lot of the companies I mentioned, the healthcare conglomerate, the big oil company, the railroad, the telecom in Canada, the turnaround engine maker in the UK, the pipe maker, all these things that have some kind of internal driver, they're probably going to pay more dividends than the glamour stuff. And that's really exciting to me. Okay. So but the point is it's dynamic. It's dynamic depending on what valuation gives us.
And we know that that's what you stay focused on all the time. It's wonderful to speak with you. Thank you, Ramona, for your time, and we look forward to seeing you again soon.
Thank you. Nice to see you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.